All right, Ken Mahoney, there you have it. Dan Niles has had fantastic performance. He's looking for, at a minimum, 10 to 20% sell-off in stocks around Jackson Hole, which is in August. What do you think?
Look, it could happen, Maria. And look, I think we kind of grind higher. And look, we all get the inflation story, right? Wages are going up. Wholesale prices are going up. They pass it to producers. Those producers, put it to consumers. And how we have this little cycle. But I have to tell you, look at the 10-year Treasury. Look at the bond market, Maria. The bond market's not believing this story of high inflation. If it were, the 10-year Treasury yield would probably be, 3%, 3.5%. So we're not quite there yet. I think the bond market's sniffing out that maybe the Federal Reserve is correct, that this is transitory demand that's happening after being cocooned for so long, and now we're getting out and spending, giving some time for supply chains to come back up. So I'm not in that camp right yet, because the bond market, which, by the way, the 10-year Treasury is really the biggest market that's out there, the most liquid market that's out there, and probably the most efficient market that there is. And the bond market's not buying it right now. So I'm gonna stick with the bond market for the moment.
I think you make a great point, Ken. We just were looking at the 10-year. It's at 1.5%. When you've got these kinds of rock-bottom interest rates, the term TINA comes up. There is no alternative. And if you can't get yield anywhere else, you're going to go to dividend-paying companies in the stock market. But, Keith, all of these record levels on interest rates have pushed everybody out the risk curve. That's why we're seeing this activity in crypto. The price of Bitcoin slumping, though, over 10% before recovering yesterday. You've got other crypto names like Dogecoin, Ethereum, also under pressure. Amid fears that we're going to see more government interference in crypto, all this as the Justice Department recovered millions of dollars in Bitcoin ransom from the Colonial Pipeline hack. That puts into question this whole idea of anonymity. And when you move Bitcoin around, they just took the money back. Keith, your thoughts on crypto?
Well, here's the thing. Either you believe in it or you don't. To me, the world is going to distributed finance. So there is going to be a role for cryptocurrency. Whether it's these three, Dogecoin, Ether, Bitcoin, who knows? But they're very different. Dogecoin is a Vegas lottery ticket. Bitcoin was first into the space. Ethereum is the building block. So you've got to parse that. And the third thing is, what this really highlights, Maria, is not the risk associated with the coins themselves, but the risk of concentration. You have a huge number of players, 80, 90%. Controlled by a relatively small number of actual holders. So the ransom situation exposed the flaw. It exposed the fact that people can look at it, they can get to it. Passwords are the weak point. It's going to prompt a new generation of biometric identification, et cetera, et cetera. I still believe in it, but I am backing off my purchases until I get a little stability.
So that whole hack and the recovering of the crypto money is making you back off a little. You learned something, too, with this hack.
Exactly. Yeah. Exactly. Passwords are the weak point, and they always have been. Okay. And that's the key. But does it change the belief in the cryptocurrency for my mind? No, not one bit.
Katie, we talk a lot about the macro story, and the macro story looks good. We are looking at growth for 2021 in the backdrop. The economy should be good for earnings. But let's talk about what the charts tell you. You're looking at technical strategy, the volatility index down to pre-COVID levels for the first time since the pandemic began. Your reaction to this, and what other charts strike you right now as far as informing you on how to allocate capital, Katie?
Well, I do think we're right to be focusing on that volatility index, or VIX, because it's a transactional gauge of market sentiment. And as it stands, it does show some complacency in the market. Now, I'm watching it as an indication of whether we should be hedged or not here. And at current levels, it does suggest that we should be hedged in terms of managing risk of a pullback in the S&P 500, to which it's inversely correlated. The reason for that is that the market, since April's run-up, has seen a loss of intermediate-term momentum, and it's held up remarkably well in light of that. So I want to be respectful of that. S&P 500's up near its highs still, of course. However, that loss of intermediate-term momentum has been associated with a lot of underlying rotation that has made it a really difficult market for folks to take advantage of. And unfortunately, I think we may be in store for more of the same sort of through the summer doldrums. Seasonal influences right now are not great for the market. That occurs from about May until October. So we're watching that VIX very closely. If it were to break down, we'd feel better about the equity market, meaning that complacency is here to stay, something that can be upheld longer. However, as long long as that VIX holds support from April, which is at 1538, I believe the VIX is above 17 this morning, we want to stay hedged here, just given that risk associated with the summer doldrums and also that loss of momentum.
Well, it sounds like if you're going into the summertime with some hedges in place, you agree with Dan Niles that we could see a pretty good sell-off in stocks by the end of the summer.
I wouldn't say 10 to 20% looks in the cards based on my indicators at this time, but I'd definitely be respectful of any breakdowns that do occur.
All right, we will leave it there. Katie, great to see you. Great word on Wall Street. Keith Fitzgerald, Ken Mahoney, and Katie Stockton. We will see you soon. Have a great Wednesday, you guys. Thank you so much. We will be right back. Stay with us.